Yeah, good day, everyone. Today being Saturday, the 6th of May, 2023, we will be having various interactions at the introductory stage of earnings per share. And we'll be discussing this in line with the requirements of IS 33, with border on earnings per share. And now when we talk about earnings per share, the word could not what it is. We are looking at the ratio of earnings to the number of ordinary shares held by the shareholders. And today we are going to look at it extensively by trying to understand what earnings per share is. And if you recall, in our interactions on financial ratios, you'll find out that we've discussed earnings per share, but just passively, as we discussed it with respect to just computing ratios. But at this point in time, we'll be discussing it extensively so that we can have a better appreciation of what it is. And on that basis, we'll be making use of our material as made available to us and as we have it also on the screen. Okay. Now, when we talk about earnings per share, once again, we are looking at this ratio because it plays an important, or what I could call a pivot or pivotal role in the course of accounting, or what we call financial reporting and finance activities. Now, earnings per share is one of the metrics that is used by existing investors, potential investors, management, institutional investors, analysts, and the like, to appraise the performance, the trajectory, and the direction to which an entity is going, more especially on a comparative basis with its peers. And on that basis, it's critical for us to standardize how this metric is measured, all because it influences significantly some other things that goes into decision making. And where it's much more of effects is on determining what we call a PE ratio, price earnings ratio of a business, which is, if not the most important ratio, that is used to determine the value of a business and how valuable a business is to another. It's also used as a ratio in pricing when it comes to M&A transaction. M&A means merger and acquisition. It's also a ratio that plays an important role in the classification of enterprises or businesses into value stock and growth stock. Value stock are seen to be those that have a P ratio that demonstrate that they are matured entities. While a growth stock are much more those with significantly high P ratio because they are in their growth or developmental stage in its life cycle within the capital markets. But there are a lot of things that earnings as an input to determine PE play in the corporate world. And therefore, this is one of those reasons why I believe or I know the ISB dated back to engage in a project where the basis of measuring earnings per share is standardized. And the standardization comes from two perspectives. One, ensure that the same parameters and variables are adopted by all entities in computation of earnings per share. And secondly, not just to limit earnings per share to what is perceived to be the current status of earnings per share, rather, it also goes beyond anticipating the likelihood of reduction in earnings per share, not as a result of the business performance, but as a result of potential dilution, which may be attributed to events or actions taken today or in the past with respect to changing or mixing the capital structure, most especially the equity structure of the entity, thereby creating potential dilution as a result of the existence of potential ordinary shares. And this usually arose from contracts between the company and others, which potentially could create additional ordinary shares to new set of shareholders, thereby creating dilution to existing shareholders. The principle is basically all things being equal. Let's say our earnings remain the same or changes in a proportion that is not commensurate to increment in the issue of shares, thereby creating a future reduction in our earnings per share to existing shareholders. And therefore, the standard makes us understand that at every point in time where we are to disclose earnings per share in the financial statements, we have the responsibility to disclose the two forms of earnings per share. The one that speaks solely to today, and the one that likely speak to the potential reduction in our earnings per share in the future as a result of the existence of potential ordinary shares in the current period. Therefore, we can move on in this light. Now, when we look at IS 33, IS 33 makes us understand that a similar like in which we report earnings per share in the individual financial statements of an entity, similarly, we will do same in the consolidated financial statement of an entity, which means the same requirement apply to disclosing or presenting earnings per share in the financial statement of an entity, and similarly, it applies to consolidated financial statements of a group. Also, earnings per share is it required to be disclosed or presented by all entities that prepare financial statements? The answer to this will be no, or not necessarily required. Next question then is, which categories of entities are bound by this requirement? The requirement to disclose earnings per share in the financial statement of an entity at every reporting period or date is restricted to companies that are listed entities. When I say listed entities, we are talking about companies that are quoted in the capital market or as the securities listed in the capital market, or is intending to be listed in the capital markets. Therefore, it is critical for us to understand this. And if that is the case, does the standard then prevent any other entity to disclose earnings per share in its financial statements? The answer to this is no. But there's a condition to it. Though you are not mandated to disclose earnings per share as an entity that is not listed in the capital market, but where you choose to disclose earnings per share, you are mandated to disclose it and present it in the same manner as required for a quoted entity for you to be IFRS compliant. What it simply means is that though you are not allowed or you are not compulsorily required to do so, but where you feel like you want to join in doing so, you must do so in all respects as may be required by the standards. And that is the critical point I want you to take note of. Second point I want you to take note of is that although IAS 33 predates the period in which IAS 1 was revised, where financial performance are further delineated into two components, profit or loss for the year and other comprehensive income. This standard has always been there where there is no other comprehensive income. What it simply means is that now that in the last decade or more, where improvement has been made to presentation of financial statements, where we have two statements in one or separately depicting profit or loss for the year on one hand and depicting other comprehensive income on the other hand. The question then is, on what do we compute EPS on as our earnings? Remember, earnings per share, EPS, stands for the ratio of earnings to the number of ordinary shares. The question then is the earnings. Is it profit for the year? Or is it other comprehensive income? Or is it profit for the year plus other comprehensive income, which we call total comprehensive income? Now, I'll repeat that though the development of delineating comprehensive income into profit for the year and into other comprehensive income came after IAS 3. That still did not change the parameter or basis for measuring earnings as other comprehensive income is not seen as a primary source of measuring financial performance, the business is expected to continuously generate earnings on a sustainable basis, and also is not critically a measure of management performance in the running of the business. We then simply put that at all point in time, other comprehensive income will never be considered in the computation of earnings per share, which means we will restrict our computation to the bottom line within the statement of profit or loss, or what you call the income statement, and it will not be extended to other comprehensive income. Thirdly, when we say earnings, what comes to people's mind is profit. Does that mean earnings per share is only computed when they are profit to an entity or to a group? And what happens when there's a loss in that group or in that entity? Now, again, the word earnings is used loosely in this case to imply profit or loss, which means positive earnings is a profit, negative earnings is a loss, which means when you have profits, we can describe it or have the nomenclature of earnings per share. But secondly, when we have losses, we also compute earnings per share, but usually we qualify it as loss per share. Though when it's profit, we barely use the phrase profits per share, we use earnings per share. But once it's a loss, we usually qualify it as loss per share. Okay, I just need to emphasize that, which means earnings per share is computed with respect to profit, and likewise computed with respect to losses. Okay, these are the introductory things I need to bring to our understanding. Okay, to repeat it again, I will say earnings per share is a measure of the amount of profits or probably losses earned or suffered by a company for each ordinary share. And we'll come back to defining what earnings can take in terms of forms and what number of shares can take in terms of funds. And those are the critical discussions we'll be having today. Okay. And the objective of IS 33 is to improve the comparison of the performance of different entities in the same period and of same entity in different accounting periods, thereby prescribing methods for determining number of ordinary shares to be included in the calculation of earnings per share and other amount per share, and by specifying the way and manner to which we present them, either within income statements and the footnotes, or within the notes to the financial statement, as the case may be. These are the things that we are going to consider extensively as we move on. Okay, again, before I come to terminologies, I want us to see today that the two which I've mentioned earlier, the two earnings per share you are required to disclose are basic earnings per share and diluted earnings per share. And we're going to come to that next. Now, another thing I will mention to you, which is rare, except in a situation where you have a discontinued operation. Okay, I believe you had discussion on IFRS 5 on non-current assets held for sale and discontinued operation. Now, a discontinued operation comes in a situation where a business might have more than one division or business units or profit center, as the case may be. And in that light, we discover that the business shut down one particular business division. And if you have 4 divisions up to now, and this year you are shutting down one, how do you communicate the effect of that beyond just communicating that we are closing down a division? Is that you are going to communicate it with respect to the financial effects of such a shutdown. And what is the communication? The communication is simply for them to be aware of the future implication. These are things, the profit or loss that emanated from those shutdowns in the current period. What that means that in any year, we shut down a business division, which is material and integral part of your operation as a company. You then need to present your income statement by separating your continuing operation performance from your discontinued operation. And that's why you will have seen in some financial statements where you see at the top head, you see continuing operation. And therefore, they present the financial statement for continuing operation. And instead of arriving at profit for the year, we see something like profits from continuing operation. We need to see another heading, discontinued operation. You now see the income and expenses of discontinued operation shown separately under that heading. And what you are there is the profit or loss on discontinued operation. It is the sum of the two profits that will make up for profit for the year. The essence of that is to show the shareholders or other stakeholders that going forward, we may not expect income from the 4th division, which is now being shut down. And what that presupposes is that next year, when they are making comparison, they'll be making comparison based on apple for apple, which is based on the 3 divisions that were not shut down this year and the 3 divisions that continue to operate next year. All because they do not anticipate any performance or contribution from a shut down operation. And how does this affect earnings per share? To find out that in earnings per share disclosure, in any year we have such a discontinuation of an operation or division or business unit, which is material to the business. Therefore, we also need to disclose our earnings per share based on continuing operation and discontinued operation. All because for comparison going forward, we'll be comparing the performance of this year's earnings per share on continuing operation with earnings per share on the operation next year and years to come. And this is majorly for us to have a better and informed basis in decision making by various stakeholders. And that's it. Now, let us now talk about some terminologies that we may be coming across at every point in time in the course of this discussion. Now, the first one is what I'll call anti-dilution. Now, anti-dilution is whatever you've done with respect to creating potential ordinary shares in the current period that is likely going to increase your earnings per share at a later date. which is whatever we foresee as a result of the creation of potential ordinary shares which emanated from the contract scheme that is likely going to increase your earnings per share, assuming your earnings remain the same, or increase in a proportion higher than increase in the potential ordinary shares. We say such a potential share or potential shares are anti-dilution. Because what dilution means reduction. But if what's supposed to cause reduction is causing an increase, we say it's anti-dilution. The other one is contingent share arrangement or contingent share arrangement. Now, this arrangement is very simple, whereby shares will only be issued upon condition being attained. And which means that it might be shares you want to issue to your executive management upon them meeting certain performance level. And which means if condition is attached to you having shares in the future, though the contract has been sealed today, and that condition is other than passage of time, but condition that relates to performance or otherwise, it then means that such arrangement will be considered contingent share arrangement. When you get to IFRS 2, share-based payments transactions, you understand much more of this kind of scheme that we can call share acquisition rights and some other things, which you'll see in that. But again, you can work in detail on detail. But at this level of financial reporting, for those preparing for Ican skills level or ACCA skills level, you will not be exposed to share-based payment transaction. Okay. Contingently issuable ordinary shares is similar in nature, which means the shares you issue as a result of contingent share arrangements is what we call contingently issuable ordinary shares. Now, the word dilution. Now, though this might have been explained earlier, but because the terminologies were arranged in alphabetical order. But now, what is dilution? Dilution is simply the expected reduction in the earnings per share in the future period, all other things being equal, but being attributed to the fact that existing potential ordinary shares may vest or may be executed to becoming ordinary shares that rank for dividend pari passu with existing ordinary shares in the future. Which that means that if they're coming in, earnings per share still remains the same, or earnings per share increases in a proportion that is not commensurate to the increase in the denominator, which is the number of ordinary shares added to the existing. Therefore, we could say the earnings per share is potentially diluted, and therefore the potential ordinary shares may dilute our future earnings. And in that situation, this begets the requirement for computing diluted EPS. And in the other parts of this discussion, we will be discussing diluted EPS. But we can't discuss diluted EPS without laying the foundation of basic EPS. Option warrant and other equivalents are potential ordinary shares, or they are examples of potential ordinary shares, which usually are financial instruments that may give rise to the holder having ordinary shares of the entity being issued to them at a future date. And when we talk about ordinary shares is more or less a paramount example of an equity instrument that gives residual interest ownership in the net asset of an entity to which all what is left as residual, including profits, are attributed to. Though ordinary shares can come in different classes, okay, but at this junction, we are going to look at the class of ordinary share being a single class, where all shareholders are of the same class and the shares rank pari passu in distribution of profits. Okay, as I've also mentioned before now, when we say potential ordinary shares, what are we talking about? We are simply talking about any form of contract, either by way of financial instrument or not, that may entitle to the holder of such contract to the ordinary shares of the entity at a later date. And in that situation, we say such contracts have given rise to potential ordinary shares. And take note, potential ordinary shares are not ordinary shares yet, but they are likely, other than not, of being qualified to be issued ordinary shares at a later date once all conditions are met, including passage of time. And therefore, the word potential debt qualifies that they are not existing ordinary shares that rank for dividend, which you are going to see. In the computation of basic EPS, it's only existing shares that are taken into consideration. And that is why we delineate or separate basic EPS from diluted. It's only when we cross to diluted that we now start to take cognizance of what could cause dilution. And what could cause dilution, if it exists, are nothing other than the existence of potential ordinary shares. And practical example of potential ordinary shares are convertible securities like convertible bonds, convertible preference shares, options and warrants, contingently issuable shares, if certain conditions are about to be met and they have not been met already, and some other categories like that. And we are going to look at about 3 or more of those categories in the other part of our discussion when we get to diluted EPS. Put options on ordinary shares again are equally an example of what is potentially be considered ordinary shares or qualified ordinary shares in the future. Okay, and put options on ordinary shares that gives the holder of such financial instrument the right to sell their ordinary shares at a specified price for a given period. Okay, that's that. All what I've discussed now are the introduction to earnings per share. At this point in time, before I now more or less introduce you to basic EPS, which is the bone of our contention in today's discussion, I want question, contribution, or otherwise. And you can do that by show of hands or by sending your question on chat. Thank you very much. Any question at this point? Okay. No question at this point. Okay, in that light, let us now venture into basic words. Now, basic EPS is measuring your earnings, which are current earnings, as a ratio of your weighted average number of shares. Now, doing this, we then need to define the numerator and the denominator. What are earnings? And what constitutes weighted average number of ordinary shares? Now, earnings can be viewed from different perspectives. We'll start from the basic principle. Remember, I've discussed the issue of continuing operation. Now, I think what I'll do is let me switch to my notes and use that to create illustration. Okay, now recall that EPS can be seen from two angles, basic and diluted. Okay. Now let's look at basic EPS. The general formula for basic EPS is earnings divided by the weighted average of numbers of ordinary shares. Now let me start from the numerator. Earnings. When we say earnings, for a single entity, it could take any of this form. Earnings could be profits for the year. Okay, in this case, it has no preferred shares, or it has preferred shares but they qualify as a financial liability. In accordance with IAS 32. Remember, we discussed IAS 32. Also, it has no discontinuous operations. These are the conditions where we only use profit for the year. Which if you take it, look like and see your profit for the year, when there's no preference share in capital structure, or there's preference share, but they qualify as financial liability, or there's none of those things, and equally there's no discontinuous operation. But earnings can also be profits from continuing operations. And this is only on the premise that there is a discontinued operation. Earnings can also be profit for the year, which is seen as profit after tax, minus preference shares, preference dividend. And in this case, it means you have preference shares and they qualify as equity instruments. And the reason why you are deducting it is because this preference dividend has not been deducted by way of finance costs, unlike here that it has been deducted by way of finance costs if it is treated as a financial liability. With this profits after tax is what sticks to both preference shareholders and common shareholders. But preference shareholders has a key token which you have to take with you before you arrive at what is the residual. What is the residual to the ordinary shareholders? Okay. Now, I think for this single entity, that's where I will stop. Now for a group. Earnings is a good profits for the year. The same thing applies, but in addition, the group, you see, in addition to what we have here, the group has no NCI, therefore the entire profit for the group will be the same. But earnings, profit after tax, which is what you have minus what? NCI. In this case, the group as NCI. I remember when we get to the denominator, we qualify what we mean by ordinary shares. Okay. Also, what if the group has preference shares? It's also earnings is the group parts minus preference dividend minus NCI share of profits. Now, when you say NCI here, it is NCI share of profits, not NCI as a value. Okay, take notes. The same thing happens if the group has a discontinued operation, it then means it should be profits from continuing operation minus preference dividend minus what? NCI. All of these are the definition of what? Earnings. When it comes to this. Okay. Somebody said the volume is low. Okay, can you hear me better now? Can you hear me better now? Okay, I'll continue from where I stopped. Okay, now the second thing is to define what is the weighted average number of shares. Now, before then, I'll consider defining or explaining ordinary shares. ordinary shares. Now, the first condition is this. We are considering shares that have residual interest in the net assets of an entity. 2, we are considering shares, that is ordinary shares, that are in issue. This is what makes them existing and not potential ordinary shares. Now, 3, we will consider the time proportion to which the shares contributed capital to do business that resulted in the amount of earnings for the year or period. Period means if you do interim report, it might be quarterly and the like. Now, this is where the issue lies. The issue lies much more in this kind of proportion, because it's easy to know shares that evidence residual interest, which are ordinary shares by definition, and that they are already in issue. But again, the time to which they are in issue, where capital has been contributed, also play a pivotal role. And that is where the major issue lies. And therefore, we are going to consider it in detail, which means the timing as a factor is critical to what we are going to discuss. I think so. Now, in doing this, we now have factors that contribute to the adjustments happening the weighted average number of ordinary shares. And these factors include A, new issues at full market price. New issues at below market price. New issues at zero cost or price, which I can call bonus words issue. This I can call usually right words issue. Again, we consider issues where we have treasury shares. And when we say treasury shares, what do we mean? That is, the company buys back its shares. And probably we consider issue of shares reconstruction. Okay, we can do share splits. and reverse share splits. Or what we call shares consolidation. All of these are what we're going to consider in all of our discussion at this point in time. Okay. That's for now. Before we go deeper into our discussions, any questions so far? Any questions so far? Okay. No question at this point in time. Now I'm going to share the material once again. Somebody is asking me, is the material okay? Can somebody share it in the group? Okay. Let me even share it by this platform. I think I have access to sharing it by this platform. And all of these documents will also be available to you via the YouTube link or the WhatsApp group. Okay, now let's start with all of what I've discussed, what we have here. And let's start with scenarios. Now, I want one or two persons to volunteer to read by signifying the hand. And most especially the person that always reads for us in class. If you are here, just show by hand. Can you raise up your hand so that you can read the first scenario for us? And we'll move on from there. Otherwise, can somebody else signify? Can somebody else signify to read? Can you guys hear me? Can you have a show of hands to read? Otherwise, let me see who I can call here. Kizito, over to you. Can you unmute and read? Since your network is poor. Is it my network or yours?
Okay, can you hear me? Scenario 1.
Yeah, I can hear you.
Hello?
Yeah, we can hear you. Go ahead.
Okay, scenario 1. Simple basic EPS with or without preference shares. Arsenal PLC currently has 1 million ordinary shares in issue. As of its reporting date, 31st December 2019, the profit after tax for the year was 5 million naira. There has been no new issue of shares during the year. Required, calculate the basic earning per share for the year ended 31st December 2019, assuming A, no preference share capital is currently in existence. B, there is an 8% preference share capital of 20 million existing from the beginning of the year to the reporting date. But assume figure 1, preference share capital is treated as equity with reference to IAS 32. 2, preference share capital is treated as financial liability with reference to IAS 32.
Okay, thank you very much. Thank you. Okay, now let's switch this to my notebook. Okay, we use Excel to do this, and I'll copy the question here. Okay. Now let me bring out the variables. Number of ordinary shares. As at what date? As at the reporting date, which means it has been existing from the beginning of the year to the reporting date. We are told it's 1 million shares. $1 million shares. Profit for the year. We are told is 5 million naira. Okay, that's 1 million shares, and the profit for the year is 5 million. Okay, what again? Yes. Now, A says what? A says where there's no preference share. Now, what's our basic EPS? Our basic EPS for 2019 is my earnings attributable to ordinary shareholders divided by the weighted average number of ordinary shares. Now, what is my earnings? Very simple. My earnings is 5 million. What is my ordinary shares? 1 million. And therefore, how much do I have? This divided by this, it gives me 5 naira per share. Very straightforward. Now, but B says what? B1 says we have preference shares which qualifies as equity in line with IS 32. Therefore, if that is what happens, what then should we do? That means that the preference dividend has not been deducted from the earnings. What that means that in this case, which I can further break down as follows and say, here is my profits for the year, less my preference dividend. That's the only thing that is changing there. Now, what is my preference dividend? My preference dividend is a fixed percentage of my preferential capital, which means notes preference dividend is 8% of 20 million, right? I can put it here. And what does that give me? 8% of 20 million. That gives me 1.6. Therefore, I can come here to say, this is my profit for the year minus this. And this is this, 3.4. My number of ordinary shares to remain the same, 1 million. And therefore, what do I have? And that is that. Okay. Now, this is on the premise of this as our working notes. I'll call this my working notes or my workings. Now, B2. B2 says preference share capital treated as financial liability. And if preference share capital was for financial liability, what will have been the notes? Let me write it here. Note. Given that preference shares qualify as financial liability under IS 32, it then suggests that the preference dividend would have been deducted as a finance cost, except otherwise stated. In arriving at the profits for the year. Hence, no further deduction is required. Therefore, in that case, the same answer we have as A is what we are going to have here. Okay, which means our earnings per share is still earnings attributable to ordinary shares divided by weighted number of ordinary shares, and therefore preference dividend will not be deducted. And this is what it will be. And in that case, I go back to my earnings and my shares. And that is that. Which means A and B2 will give you the same results on the premise of the information provided. And again, let me go back to my notes here to refresh our memory what we discussed there. Remember what we discussed here? And I can copy that. Any question? You can show up your hands. Before we move to the second one. Okay. No question. Therefore, that's question 1. Question 2. Let's go back to our question 2. Who will read question 2 first? Please signify by raising up your hand. Otherwise, I call randomly. Okay, Monica, over to you. We have given you access to unmute. Question
Arsenal
2.
PLC. Can you hear me?
Yes.
Arsenal PLC currently has 1 million ordinary share in issue as of its reporting date, 31st December 2018. The profit after tax for the year was 5 million. There was an issue of 200,000 ordinary shares on 1st April 2019 at the full market price of £4.25 per share. Required. Calculate basic earnings per share for the year ended 31st December 2019.
Okay, thank you very much. Now we have the question in our workbook. Arsenal had 1 million shares as at the reporting date 2018, which means without any other information, the 1 million shares has been there from the beginning of the year to the end. The profit after tax is 5 million. And we are told that new shares were issued. When were they issued? Issued as of 1st of April 2019. And how many shares are there? There are 200,000 shares. And they were issued, new shares issued at full market price. And what's the market price? £4.25. Now we have nothing to do with market price, it's just a guide. And you see the implication later when we get to right issue. Now, this is our information. The question then is, we need to compute our earnings per what? Per share. Now, our earnings per share is the weighted average number of shares in issue as at the reporting what? Date. Now, we are going to take into cognizance the information before us. Now, when you check what is at hand, you find out that 1 million shares were outstanding as at 2018. But our reporting date is 31st December 2019. What it simply means is that these shares have been in issue since last year. given that last year was 31st December 2018, which means this 1 million has remained there since last year till now. But during this year, given that our year run from January to December, as you can see it here, you'll find out that the company issues additional 200,000 shares on 1st of April 2019, which was 3 months after the year begins, which is also the same thing as 9 months to the year end. Therefore, how do we compute our weighted average number of shares? That's the only problem we have here. We have no problem with our earnings, since there's no other nature of equity or shares in the structure. But we have a problem with this number of earnings because of the factor we consider as time proportion. Remember, if you go back to our material, yeah, I'd make mention of something critical, time proportion. Okay, the two conditions are fulfilled, but what we needed to do now is to consider time proportion. And therefore, what do we do at that point in time? I return to my, that means that there are two approaches. Approach one, for determining the weighted average number of ordinary shares in issue. Therefore, I can start with class of shares. Class of shares is existing shares as of 31st December 2018, and new shares as of 1st of April 2019. Now, what is the number of shares? There are 1 million shares as of this date, and 200,000 coming to join them. Now, the question then is, how long has this time, just call it time span, now these shares will have stayed till 31st December 2019, and that is a whole year of 12 months. And this will have stayed from 1st of April 2019 to 31st of December 2019, which, if you count it very well, is 9 months. What does that mean? It means the capital relating to 1 million shares has been the business generating earnings, while that of new shares is generating earnings for the first time, and is only generating it, or has generated only for 9 months, because money that was not there in January, February, March will not have contributed to profit in that period, which means it will only contribute to profit by increasing our profit between April, May to December. Therefore, these are the months in question. Let me put it there so that you can get it in months. Therefore, what then is the time fraction or time proportion? It is how long has it stayed out of the conventional 12 months that make a calendar year? This has stayed for the whole year, which means is 1. And this has only stayed for 9 months out of 12-month calendar year, which means it's 0.75 of the time. And therefore, this is our weight. Now, what is our weighted average? Our weighted average number of shares is the product of the weights and the time span. Sorry, product of the weights and the number of what? Shares. And which means this will rank pari passu, but this will only rank as a fraction of 75%, which means 200 shares for 9 months, capital is equivalent to 150 shares for 0.75 fraction of a year. And that is what it means, which means 200 shares for 9 months is equivalent of 150 for a whole year, which then means that our sum of weighted average is this. Okay, now this is what we are looking for, and that is it. And once you do that, what is per share? Our earnings per share is 4 naira 35 kobo. Basic EPS. Now there are two methodologies to doing this. I'll show you the second methodology. Okay, the second methodology or approach is this. I'm coming to answer two of you, Glory and Philip. So I can see you raising up your hands. Now, the second methodology is to consider periods and consider number of shares. So, what's the period? The period is to look at beginning of the year starts from January 2019 and up to 31st March 2019. There were only 1 million shares outstanding. But from April 1st, 2019 to 31st December 2019, it's no longer 1 million shares, but 1 million plus the new shares of 200,000, which means this 1 million existed to this date, plus the 200 that came on 1st of April, which means only for 3 months we have 1 million shares, while for 9 months we have 1,200,000 shares. Therefore, this is for 3 months, and this is for 9 months. The sum is 12 months. Now, what is the fraction of this? The fraction of this is as you've seen it here. 3 months is equivalent to 0.25, and 9 months is equivalent to this. When you sum it up, is 1 year, 1 full calendar year. And therefore, we'll find the weights and we'll get the same thing, which means 1 million for 3 months is equivalent to 250,000 for 1 year, and 1.2 million for 9 months is equivalent to 900,000 for 1 year. When we sum it together, we arrive at the same thing, and that is that. Now, it's left for you to choose which methodology suits you more. But I will tell you, and I will advise you that we'll be using more of the second methodology as situation get complicated, because it's easy to deal with methodology 2 when things get complicated as time goes on than methodology 1. But that is just to show you by way of understanding. Okay. Therefore, what's the question? Philip, over to you. I can hear you, Philip. I think your network is bad. Glory, over to you. You can send a message. Glory, over to you.
Hello, sir.
Yeah.
Hello, sir.
Go ahead. Go ahead.
Okay. Based on the question, you said Arsenal currently has 1 million ordinary share in the issue as of its reporting date, 31st December 2018. So now when solving the question, you wrote reporting date 2019. So I was thinking, is that 2018 not supposed to be 2019?
No. What they are telling you is that as of reporting date of 2018, he had how many shares?
Okay, 1 million.
Now, in 2019, there was additional issue on 1st of April 2019. What it means is that plus what you are carrying from 2018, in 2019, they are being increased to it.
Okay.
If I tell you that last year, what they're saying is that last year I had 1 million shares. This year, in April, I've issued additional 200 million shares. What are they trying to tell you? What are they trying to tell you? Can you answer, please? What they are telling you is that 1 million has increased by 200,000 to 1.2 million by the end of 2019. That is that. Okay. You guys can put your hands down. Okay. Any other question? If not, let's go to the third question. Scenario 3. Who will volunteer to read? Please kindly raise up your hand. Okay, Joy, you can read.
Okay. Scenario 3, basic EPS with the issue of bonus shares. Arsenal PLC currently has 1 million ordinary shares in issue as of its reporting date, 31st December 2018. The profit after tax for the year was 5 million naira. There was a bonus issue of 1 for 10 ordinary shares existing on 1st April 2019, when the bonus was approved and issued to existing shareholders. The basic EPS for 2018, given no new issue of shares in 2018, was 4.58 naira per share. Required, calculate basic EPS for 31st December 2019 and the adjusted EPS for 2018.
Okay, thank you. Thank you very much. Okay, let's switch to our now. This question borders on bonus issues. Now, again, I can borrow a leaf from here. This borders on new issues at full market price. Okay. Arsenal currently has 1 million shares in issue as at last year, reporting the 2018. Now the profit for the year after tax is 5 million, yes. There was bonus issue, okay. Now, bonus issue. As at when? As at 1st of April 2019. And the bonus issue is 1 for every what? 10 existing. Okay. Now, the basic EPS for last year basic EPS for last year, 2018, was 4.58 naira. Therefore, what then do we do? We are told to calculate basic EPS for this year and adjust it. I'll copy this. Now, what is my earnings is not affected, 5 million, but I have problem with the weighted average number of shares. How do I determine that? Now, I need to take note of the following. Working notes. First, what is the number of bonus shares? What's the number of bonus shares? Now, existing, you say 10. Bonus. Existing ratio. Bonus ratio. You said 1. What does that mean? For every 10 shares that anybody owed, they are going to issue 1 additional share free of charge for that person. Which that means invariably that person is going home with 11. Which means having 1 to existing 10. Now the question then is, If we have 1 million shares before now, as at last year, and in April, you are issuing bonus shares, how many bonus shares have you issued? It will be 1:10 of existing shares, which means invariably bonus you have issued is 100,000. When you add it together, what do you have? You have 1.1 million shares. Now, the question then is, in bonus shares, what will be the ranking? Now, we can use, let's start with this methodology. Now, you have existing shares from December 2018 to December 2019, 1 million shares. You have bonus shares from 1st of April 2019 to 31st December 2019. How many shares? 100. Therefore, the question you ask yourself is, how do we treat time proportion for bonus? Take note of this asterisk, and I'll bolding it for you, and I'll use it to explain something to you. What is bonus shares? Bonus shares implies that a company issues shares out of retained earnings, which means its internal source of capital. That capital already exists in the business prior to the day the bonus was issued, which then means that the principle of time proportion will not apply, because the bonus was issued out of the retained earnings that existed and not distributed as at that last year, which means anytime bonus is issued in a year, the simple methodology or principle is that the bonus is deemed to have been in existence as at the beginning of that year, or as at the earliest date in which the year that qualifies for the bonus is in issue. Which that means that invariably, yeah, you are also going to use the same proportion for the bonus issue. And therefore, it means the time factor will not affect bonus issue. And that is that. Which then means that invariably, my number of shares for bonus is 1.1. And therefore, my earnings per share is 4.55 naira. But there's a problem. What is the problem? The problem is that if we compare earnings per share in 2019 with earnings per share in 2018, and they say make comparison and make recommendation or evaluate the performance, you discover that we erroneously say 2018 of 4.58 naira is better than 2019 of 4.55 naira. But what is the problem? Remember that the retained earnings existed in 2018. And it's not the same retained earnings that was used to issue bonus, which has not brought in additional capital. It is still the same resources that existed in 2018, that existed in 2019, only that we are doing mere recapitalization or capitalization of retained earnings to share capital, which means that should not impact our performance because it's still the same resources between 2018 and 2019. No additional capital had been injected as a result of bonus issue, which then means that in that case, we will have to carry out an adjustment on 2018 to put it on the same pedestal, given that what if the bonus had been issued in 2018, what will have been the basic EPS? It wouldn't have been 415 because the number of shares used in 2018 will have been higher because of that bonus issue. Therefore, what do? We come here to carry out adjusted EPS. Okay, let me do it here. Comparative figure. Comparative figure in 2018 will be adjusted as such. How do you adjust it? We'll come here. We'll call it adjusted EPS. And that's why when you see any financial statement, you see adjusted EPS, it's as a result of adjusting for the bonus elements inherent in the prior year. And what will it be? It's going to be basic EPS of 2018 multiplied by the bonus adjustment. And what is the bonus adjustment? What is the bonus adjustment? The bonus adjustment equal to the ratio of existing shares plus the bonus shares, would give you the new shares divided by existing shares. No, sorry. I have to take this down. Is existing shares divided by the bonus shares. Therefore, what is our ratio? Our ratio is simply 10 divided by 11. And what is 10 divided by 11? Whatever it is here. And the adjustment is always going to be less than 1. 10 divided by 11. This is the adjustment factor. Therefore, what will I do? I cannot come here and say my adjusted EPS is simply my EPS in 2018, which is 4.58 kobo, multiplied by this adjustment, therefore 4.16 kobo. Take note of this. That's my adjustment factor. And therefore, I cannot compare 2019 with 2018 adjusted. 2018 adjusted. which means this is not appropriate for comparison because this does not consider the effect of bonus. And if bonus has been issued in 2018. Remember, bonus shares does not contribute additional capital. It's just a way of retaining the existing capital in a permanent form so that it can no longer be distributed to share what? Holders. Remember, retained earnings automatically is part of capital or part of equity, but it can still be distributed. But once you have recapitalized it as share capital, it can no longer be distributed. And that is what you are trying to do. And if you are doing that, that should not necessarily change your performance because it's still the same resources that existed prior to that bonus issue. Does that make sense to you? And that is the position here. Okay. Now, again, if I've used the second methodology, let me copy the second methodology here. It will still not change our position here in case people want to see that. We only have 1 million shares then. And thereafter, when bonus was issued, we have the 1 million plus the bonus, which is 100,000. Now, the difference is that at this point in time, you will find out that instead of saying the bonus only came in April, we'll deem it fit that the bonus equally came in January. All because the retained earnings has always been there before now. Okay, and this is, sorry. This is 1 million. Plus 100,000. And that is it. You see, I have at the same position. And that's what we're trying to explain. But the major aspect of it is that where there's a bonus issue, your comparative have to be adjusted by this bonus factor. It's compulsory. Take note of it. And that is why the examiner says, calculate basic EPS for the year 31 December 2019 and the adjusted EPS for 2018. Even when you are not told and you are made to make comparison, requested to make comparison, you must carry out the adjustment on the EPS for comparative purposes. Otherwise, you'll be making wrong comparison. And that is key to you. Take note of it. Any question on that? Any question on that? Okay, no question. If there's no question, this is how we treat bonus issue in the year. Now let's move to question on right issue, where you issue shares at below market price. Who will volunteer to read? Who is volunteering? Okay, Precious. Precious Friday. Okay, before Precious, Isi Muje, you have a question? Okay, unmute and ask your question.
I want to volunteer to read, sir.
Okay, you want to volunteer to read? Okay, go ahead to read. Thank you.
Scenario 4, basic EPS with a new issue of ordinary shares at below the market price. Arsenal PLC currently has 1 million ordinary shares in issue as of its reporting dates 31st December 2018. The profit after tax for the year was 5 million naira. There was an issue of 200,000 ordinary shares on 1st April 2019 for 4 naira 10 kobo per share to existing shareholders. Before the new issue, the market price of his ordinary shares was 4 naira 50 kobo per share. The basic EPS disclosed for 2018 was 4 naira 36 kobo per share. Required: calculate basic EPS for 31st December 2019 and adjusted EPS for 2018.
Okay. Thank you very much, Isimoje. Okay, in that case, I'll copy the question and take it to our spreadsheet. Okay. Arsenal PLC has 1 million shares in issue as at 2018. That was last year. The profit after tax is 5 million. There was an issue of 200,000 ordinary shares on 1st of April at 4 naira 10 kobo. 4 naira 10 kobo. To existing shareholders. Remember this clause. Let me underline it. To existing shareholders. It has a meaning. When you restrict new shares that you are issuing to existing shareholders, what do we call that? We call that right what? Issue, which means, let me emphasize it here, right issue. That means they are the only one that have the right to the issue. That's what it means, okay? Now, before the new issue, the market price of ordinary shares was 4 naira 50 kobo. Now, it is common or usual that when you are issuing to your existing shareholders, in addition to the rights, you give them consideration. And what happens is that it is a practice that most times, but not all times, when you issue shares to your existing shareholders only, you give them additional incentive by way of buying the share price at below market price, which means there was new issue of which the existing market price is 4 naira 50 kobo, but you issue it to them at 4 naira 10 kobo, which means you are giving them like a discount of 40 kobo. Why are we doing that? And how do the company make up the discount? From where do they fund the discount? And that is what we want to discuss here. And that leads us to discussing issue of new shares at below market price. Therefore, let me put market price as of the time of right issue, so that you know why we said it's below market price. That price was 5 naira 50 kobo. Therefore, the 40 kobo, how will the company fund it, and what implication does it have on the performance of the entity with respect to EPS? Now, again, our earnings is not a problem, but what is a problem is our weighted average number of shares, which we are going to adopt any of these methodologies, but again, we are going to adopt this one much more, and you see why it's much more simplified. Now, between 1st of January and 31st of March, we have existing shares, which is 1 million. But between 1st of March and 31st of December, in addition to the existing shares, you had 200,000 new shares. Now, we'll have stopped at this, but there's a problem. The problem is that between this period and this period, there was inherent bonus. I will emphasize it here. The difference between this as a bonus issue inherent or embedded in it. How do we now adjust for that? To do that, we'll carry out certain workings, which is working synonymous to capital market operation. We'll first of all determine one we'll call theoretical X-right price. And what does that mean? Theoretical X-right price is saying that naturally in the capital markets, when shares are issued at below market price, the exchange will mark down for the amount of discount, which is the difference between this 4 naira and 4 naira 50 kobo, that has bonus element embedded in it, which theoretically the market will correct for itself or adjust for itself to determine what the price will be after right has been issued, which we call theoretical X right price. And how do we determine that? There are two ways of doing that. Theoretical X right price can be determined by units and can be determined by value. We are going to see the two. And the essence is that based on how information is provided, you can determine it either way. And this is saying you are going to look at the price, the market price, or let me say the full market price, plus the right price divided by the number of existing shares ratio plus the number of right share ratio. What does that mean? I'm going to show you. The second one is based on the value, or let me say total, on the total perspective. In this case, you look at the value of existing shares plus value of rights divided by the number of right shares not in ratio and the number of existing shares not in ratio. And you get the same result at every point in time, and I'll show you. Now, how do you do that? We come here to draw it up. Class of shares. Existing shares, right shares. What's the ratio? In this question, we're told that 200,000 shares were issued. Therefore, I'll use the first approach, not ratio. Number of shares, so that I'll convert it later. Number of shares existing shares is 1 million. Right shares issue is 200,000. Therefore, total number of shares now is this, 1.2. Next, what are the prices? Existing shares has a full market price of 4 naira 50 kobo. New shares has a price of 4 naira 10 kobo. Which means when you want to value your investments, you that have 1 million shares before, how much is the value of your investments? Is 1 million times the market price will give you 4.5 million. Now imagine you are not buying additional, the same shares, you are not buying additional 200,000 at 4 naira 10 kobo. How much is it? 820. Hence, what is your total value? Is this. Therefore, this is what we are trying to do. Now, what do you do in this case? If you are using this methodology, what we are trying to do here is just simple. What is our value of existing shares? 4.5 million. What is our value of right issues? 820. Therefore, it will be 4.5 plus 820 will give you 5 point this. What is our number of existing shares? 1 million. Number of right shares? 200,000. What is the total? 1.2. Therefore, what is our theoretical right price? It's more or less like a weighted average price. And how much is it? This divided by this will give you 4 naira 43 kobo, which is our theoretical extra price. Now, if I want to do it in units, this is how I can do it in units. In units, what I would do is very simple. Now, they didn't give us conversion rate. They only give us number of shares. Therefore, I can convert the number of right issues to a ratio. And what is the ratio I'm going to do? The ratio is that if you have right issue, which is 200, and you have existing shares, which is 1 million, What is the ratio they will have given to you? Conversion ratio. Conversion ratio to 1, conversion ratio of 1 to what? It will be 1 to, for every 1 million, you get 200,000. Therefore, our ratio is at 1 to 5, which means for every existing shares, you get 1 right. That's what it means, which means in this case, the ratio is 1 to 5. The ratio is what? 1 to 5. And take notes. And that's what we are trying to do, which means this is what we are trying to do. In another question, they can give you this ratio 1 to 5. In another question, they can give you 200,000. Therefore, you should know how to do it, whether they gave you the conversion rate or otherwise, you can convert it yourself. Which means that if that is the case, you are not saying for existing 5 shares, which you have here, you have 1 share, because the conversion ratio is a base of 1. Therefore, it means for every 5 shares that you have at 4 naira, 50 kobo is 22 naira, assuming you have 5 shares. And they'll give you 1 share that you buy at 4 naira 10 kobo, which is 4 naira 10 kobo. Therefore, at the end of the day, your full market price for the ratio is 22 naira 50 kobo. Your right price is 4 naira 10 kobo. Everything is 26 naira. How come here? 26 naira divided by, you have 5 shares before, they gave you 1 right. Therefore, that is 6 shares. And that gives to you. And therefore, what do you have at the end of the day? I'll still have the same thing. And what is the same thing? This divided by this. And that gives you 43 naira. 4 naira 43 kobo. Now, what do I do with this? And this is where it plays a role. I'll be creating something here. Now, what I'll create is the bonus factor that we need to consider. And what is the bonus factor? The bonus factor is simply that there's a bonus inherent in a right issue. We account for the difference between 4 naira 10 kobo and 4 naira 50 kobo. And what is the bonus factor? The bonus factor, which is what I needed, that's the second working I need. 2, bonus factor. The bonus factor is as follows. The bonus factor is derived as the cumulative, or let me say right price divided by theoretical SY price. What is right price? I will explain. Right price is a full market price before the right was issued, which means this is the same thing as right price. That means the price before the right was what? Issued. And therefore, what is it? It is 4 naira 50 kobo divided by theoretical SY price, which we arrive at 4 naira 43 kobo. And therefore, what do we have in this situation? We have this. And when you look at it, what does that give you? It gives you 4 naira divided by this. It gives you 1 naira. Oh, let me do it not in naira. Okay, 1.02. Take note, this will always be greater or equal to 1. Okay, and this is because there was a right. Okay, now, given this, as we have it, it is a factor we needed here, which is the most critical period. The period from beginning of the year prior to when the right was issued. That is a period of our adjustment, and we are going to adjust it with the bonus factor, which is this. I can enlarge it for you so that you can see. Let me put it in 4 decimal places. That's our bonus factor. 4 decimal places. Now, we are not going to add our bonus factor to it to be able to adjust for it for the bonus element inherent. And that is what we've done. Here, we don't need to adjust because it's 1. Therefore, adjustment here for period after the right issue is 1. It doesn't change anything. But this is a period that is much more important, which is from the beginning of the year to the end of the period preceding when the right was issued. You need this bonus factor, which is what we have here that you're going to use. Now, ultimately, our number of shares is this. And we can say our basic EPS is this divided by this. Now, 4.33 kobo. But there's a problem. The problem is anytime bonus is issued, we must go back to adjust for comparative, if you remember. Therefore, it means we have to go back and adjust for 2018 EPS for this bonus adjustment. Now, what is a bonus adjustment where there's a right issue? Now we come here. Now I'll copy what I have here. Comparative figure I want to adjust. But you find out that the bonus adjustment here is different because there's an element of right there. Therefore, the adjustment here will be the reciprocal of our bonus factor. What is it? It's 1 divided by bonus factor, or you say what was numerator before will become denominator, and what was denominator before will become numerator, which means it will be theoretical S right price divided by cum right price. That's our bonus adjustment in this case. And therefore, what is that? Theoretical S right price is 4 naira for 3 kobo, and cum right price is 4 naira 50 kobo. And therefore, these are bonus, which is always going to be less than equal to 1. And I'm going to prove this less than equal to 1 again. I'm going to prove this to you. And here is greater than equal to 1. I'm going to prove it to you later. Now, this is our adjustment factor, which that means that this year now, we'll now pick last year. What is our number of shares last year? 436 kobo. So we need to put it here. Earnings per share last year. Earnings per share, sorry, basic EPS for 2018 was 4 naira 36 kobo. Therefore, we adjust that 4 naira 36 kobo and say 4 naira 36 kobo times our bonus adjustment. And therefore, we can compare apple with apple. 4 naira 30 kobo is our adjusted EPS for 2018 with our basic for 2019. Okay, remember, there are 2 adjustments here. You have bonus factor, which is to capture the bonus inherent. You know, when bonus exists, that means shares will increase by way of retained earnings recapitalized. And that is the factor we are capturing here. This is to capture inherent bonus in right what? Issue below full market price. And that's what we are trying to capture here. Take note, that's what we are trying to capture here. That's what we are trying to capture here. That's what we are trying to capture here. Take note of it. Okay, that is that. Now, somebody said I'm lost with cum right price. Cum right price is the price of your shares before bonus was issued. Market price as of the time right was issued is the same thing as cum right price. Take note of it. Let me highlight it. That's cum right price. X right price is after, which is adjusted by the capital market. Take note of it, please. Okay. Now, let's recall again. The shares we have as at the beginning of the year was 1 million shares. Profit in that year was 5 million. During that year, 1st of April, they issued new shares, but to existing shareholders at a price below the market price. Okay, now, and we said if it's issued at a price below the market price, which is a cum right price, it means that what has happened is simply that there's a bonus that is inherent that has been issued in this case. Now, basic EPS in 2018 is 4 naira at 6 kobo. Reporting date is this year, 31st December 2019. Now, to calculate basic EPS, our earnings is not a problem, but what is the problem is the weighted average number of shares. And therefore, what do? The weighted average number of shares is influenced by these metrics. And what we are just trying to do here is that, one, we are trying to adjust for the bonus inherent here. And the only thing we needed here is the adjustment factor, which we call the bonus factor. And the bonus factor is simply the, where's it? Yeah, it's simply the cum right price divided by the theoretical right price, which is the full market price divided by the theoretical right price. And remember, the theoretical is simple. You don't need to cram this formula. That's why I've done it here for you. Ask yourself, how many shares were existing before at what price in the market? This is the total value. How many new shares were issued at right? 200. At 4 naira 10 kobo, this is the value. At the end of the day, the sum of this value divided by the sum of this unit will give you your theoretical extra price, which is like weighted average price. And that's what we've done. And you can do it in units, you can do it in value. The essence of which is that examiner might come from unit angle, it can come from value angle. Regardless of where it's coming from, you are able to do the needful. And that is that. And I've also shown you how to convert value of shares to unit of shares, which is what I've done here. And the last one is that for every time there's a bonus, whether it's inherent or explicit, we must adjust for basic EPS in the prior period, which is the comparative. And the bonus adjustment here will be the reciprocal or the inverse of the bonus factor, which means here we have used cum right price divided by theoretical right price. But in the bonus adjustment, it is opposite, theoretical right price divided by cum right price. And that's why one thing that can also guide you is that at every point in time, your bonus adjustment will be less than 1 or at least equal to 1. And your bonus factor adjustment will be greater than 1 or at least equal to 1. Now, the only time it will be equal to 1 is if you issue at full market price. And I'll show you the magic here. Let us assume that you issue to existing shareholder, but you issue to them at the same price as the market, which is 4 naira 50 kobo. What will happen? You find out that this is 1, and there's no adjustment. You can see that this 36 is this 36, and we have 435. All of this, we still have this. Nothing will be adjusted for because there's no bonus in it. And you see that this is also 1. And that's what we are trying to explain to you, that bonus effect is what we are adjusting for. If you issue a full market price, this answer here will be exactly the same answer we had here. That is in question 2. Can you see? Question 2 and question 4 are the same. If you issue at full market price, 4.35 kobo, see the schedule. You see that it's not the same now. Everything we did here is still going to give you the same result as question 2, because I've changed it here that you have issued at full market price. But you didn't issue at full market price, you issue not at full market price, but you issue at below market price. And what is the below market price? 4 naira 10 kobo. And that is what brought about all of this adjustment. If not, all of the adjustments will be of no effect, and you get the same result as simple as you have gotten it here in 1. Any question in this case? Any question here? Any question here? I'll share this with you now, but before sharing it, I'm going to give you some questions which you guys are going to attempt on your own, and will compare notes, or what I'll call solutions. Let me find the question. You pick the question one by one. This is your question. You can pick the model that suits the question. I'll paste it here. I'll pick another question. That's the first. The second. And the third. Okay. This is the third. I'm going to share it in your WhatsApp and also on this platform. You can download it now. Or go to your WhatsApp. It's easy for you to download it on your WhatsApp. Okay, it's on your WhatsApp. You can go there. We are going to convert back by 1:30 after you've tried to attempt all the questions on your own. Those 3 questions, you can copy the formats or the templates and try to solve it yourself. Is that okay? Thank you. Okay, let's compare notes and see what you've done, if it's correct. I think the first question is this, and please check if it's correct with what you've done. I guess you can see it clearly. That was the first question. If there's any question on that, please let me know. To share the updated workbook with the solution with you guys. Okay, the second question. The second question, okay. Now this second question. If you need clarification, let me know. As a second. Okay. Any question on that? Okay, there's none. The last question is on earnings per share where there's a right issue. Now, remember we discussed on the theoretical exercise price, the table I drew up the other time. If you can see it here, this table is similar to the table they drew with respect to theoretical exercise price. You can see the table here. It was based on units that they did. And depending on how the question comes, you can do it in value, you can do it in units. You still get the same result as what you've seen here. And these are the other solutions to complete it. Similar to what we did before, I will carry out the adjustment for prior year with the bonus adjustments, and I will adjust for the bonus factor in the current year prior to when the right was issued. Okay, this table here is similar to the table we constructed, which I'll share again. It's similar to what we have here. This table we constructed, taking care of the period before the right issue, adjusting for the bonus factor, which is this. Okay. And remember, the bonus factor is a function of right price divided by the theoretical strike price, which is always greater than or equals to 1. While reciprocal of it is a bonus adjustment, which is always less than or equal to 1. Used to adjust the comparative. Okay, that is that. Now, I'll name it class, this solution for class 1, class work 1. Class work 2. And class work 3. I'll give you assignments to demonstrate your understanding of all what we've done on basic EPS. And this will encompass question that has new issue, right issue, and bonus issue at the same time. I want somebody to read the question for me before I share the notebook with you guys as an assignment. Can somebody volunteer to read? Jeremiah, over to you.
On the 1st January 2025, Genaco had 2 million ordinary shares in issue. On 30 April 2025, the company issued a full market price, 270,000 ordinary shares on 31 July 2025. The company made the right issue of 1 of 10 at $2. The fair value of the shares on the last day before the issue of shares from the right issue was $3.10. Finally, on 3rd September 2025, the company made the 1 for 20 bonus issue. Genaco's profit for the year was $400,000. The reported EPS for the year ended 31 December 2024 was 18.6p. Required. Calculate the EPS for the year ended 31 December 2025 and the restricted EPS for the year ended 31 December 2025.
Okay, thank you very much. That will be the assignment. Okay, I'm going to share the document on your WhatsApp, and that is that. Now, let us now quickly go into The other aspect we are going into revision for business combination. Okay, let me share the question, and I want somebody to volunteer to read the question. Okay, let me enlarge. Okay. Who has not read? Okay. Precious Ican. Sorry for the pronunciation. You pronounce it for us.
Okay.
Introduce yourself with your full name so that I know how to pronounce.
Precious Iquiwerefe.
Okay, I tried. Thank you.
Yeah, you did.
Yeah, over to you.
On 1st January 20X5, Jenna Company had 2 million ordinary shares in issue. On 30th April 20X5, the company issued at full market price 270,000 ordinary shares. On 31st July 20X5, the company made a rights issue of 1-for-10 at $2. The fair value of the shares on the last day before the issue of shares from the rights issue was $3.10. Finally, on 30th okay, this is one you want me to read?
Yeah, is it the same question you're reading?
Nope.
Okay, sorry. This is what I wanted to read.
All right. Exercise 2. Arsenal acquired 80% interest in the equity of Chelsea at 1st April 2016. The board of Arsenal strictly wants to comply with the requirements of IFRS regarding consolidation of the financial statements of the subsidiary with that of the parent as at 31st December 2016. Income statement for the year ended December 31, 2016. We have revenue, cost of sales, gross profit, distribution costs, administrative expenses, profits on before tax, income tax, profit for the year, movement in reserves, retained profits brought forward, profit for the year, retained profit carried forward. Could you please scroll up a bit? Okay, so additional information. A, at acquisition, the parent, in addition to the shares consideration, that's shares exchange, offered to former shareholders of the subsidiary a cash payment of 22 million naira, which is due to be paid on 1st April 2017 to the shareholders who sold their stakes to the parent. The hurdle rate or cost of capital of Arsenal is 10%. B, it was obtained that on 19 May 2016, Arsenal already sold goods to Chelsea for 50 million naira, when it actually cost Arsenal 40 million naira. As at the year end, included in the inventory of Chelsea PLC is 40% of the goods sold by Arsenal PLC as of 19th May 2016. C, as at the reporting date, 31st December 2016, the goodwill had been impaired to the tune of 5 million naira, and of which all the 5 million naira represents the impairment loss attributable to 2016 financial year. Required, prepare the consolidated profit or loss and the consolidated statement of changes in equity, given that the share capital of Arsenal stood at 200 million and that of Chelsea amounted to 28.75 million naira. And the amount of non-controlling interest at acquisition measured at the proportionate share of the identifiable net assets of the subsidiary, which stood at 20 million naira.
Okay, thank you very much. Okay, let's analyze the question one by one. That is the additional information. We discovered here that acquisition took effect. Acquisition took effect when? You can see it here. which means it took effect 1st of April. 1st of April 2016. And let's look at the period compared with our reporting period. We are reporting based on the information provided as of 31st December 2016. Which means we acquired this company sometimes mid-year, but in this case, 3 months after beginning of the year, which is the same thing as 9 months before the year ends. Therefore, we need to consolidate only 9 months results beginning first of April 2016. That's the first thing we took out of it. The second thing we took out of it is that there is a deferred payment in addition to the share exchange. What makes it deferred is because it's to be paid on 1st of April 2017, which means there's a deferred payment of a year from the year of acquisition, from the date of acquisition, which comes at a cost of capital of 10%. We take note of that because though we are not computing goodwill here, but we'll take care of that because subsequently we need to account for finance costs. But we have to be very careful. We are accounting for only 9 months. If you remember what we've discussed ab initio here. And this is as a result of unwinding of discounts inherent in the deferred payments. Next, we have that on this date, we have to be careful about this date. On this date, there was transaction where the parent sold goods to the subsidiary. Now, to determine or to consider this intercompany transaction, we need to consider that when the transaction took place, was Chelsea a subsidiary of Arsenal? Or are both of them a member of the same group as of that date? If it is yes, therefore, we'll consider it intercompany transaction and all necessary adjustments have to be made. If no, we'll consider it normal transaction and no such adjustments relating to intercompany will be made. In this case, remember, acquisition is 1st of April 2016, and this transaction took place about 39 days after, which is on the 19th of May 2016. Therefore, this constitutes intercompany transaction. Therefore, we need to take note of that. Also, therefore, we'll deal with unrealized profit relating to the portion of the goods that remain unsold at the year end. And finally, we are told that the goodwill has been impaired based on the assessment carried out at the reporting date. And the goodwill has been impaired to the tune of 5 million. And we are told that the entire goodwill is attributed to the loss in 2016. Yes, this is also a tautology. It's overemphasizing the situation because it's only in 2016 the company became a subsidiary. But again, this will make a lot of money if you have been having the company as a subsidiary before now, or because we need to know which period as the goodwill impairment relate to, or which periods, so that when we are preparing profit or loss, we only capture the impairment loss or gain, especially impairment loss, since there can be reversal on goodwill, the impairment loss for the current year. But in this case, the entire 5 million is for the current period because this is our first year and it has equally been emphasized. Therefore, how do we attempt solving this problem? And that's what we need to do. First, we've identified that this is acquisition during the year, and therefore we need to only capture the subsidiaries, since we have 80% stake in Chelsea. Chelsea is the subsidiary, while Arsenal is a parent. Now, I've created a consolidation schedule which may make what we are giving the information. The only thing is that I'm not interested in 12 months for subsidiary. I'm only interested in 9 months. And therefore, I'll consider 9 months of all the information here out of 12 months, assuming in this case, profit accrues evenly, which means revenue, cost, and the like accrue evenly. In that case, I recognize 9 months. I do the same thing for other items, except otherwise what stated. Okay. Now, this is my 9 month results. Okay, let me water down the blue to show that it's just a fraction. It's just a fraction of the whole. Therefore, in that case, I'll have to strike out this so that it's no longer relevant for me. I'll strike it out. But if you are doing work, you might not show it. Yeah, which means what is relevant for me is 9 months of the parent, 12 months of the parent and 9 months of the subsidiary. Okay, that is the first order. Now let me assume there's no adjustments and let me quickly proceed to consolidation, which means my consolidation is this plus this plus whatever adjustment that exists, plus or minus. And once you put adjustment, it will start to update itself. Okay. That is that. Now I'll come back to this adjustment one by one based on the information provided. Okay. Now with me, before the adjustment, let us quickly also address this. Attributing this profit, parent will take the whole of its own as a parent. NCI has no business in the parent. Why the 25 million, which is now 18,750? Remember, it's 9 months we are consolidating. Parent will take 80% based on this, and NCI will take 20%. Therefore, 80% belongs to the parent in this, and 20% belongs to the subsidiary. Now I've prepared my templates now, trying to solve the problem. I can now address the additional information one by one. The first additional information border on, I have 22 million to pay in the future, and the future is a year time. Therefore, I recognize that as of the date of acquisition, which was 1st of April, I have 22 million to pay as my deferred consideration. And off we go in thousands. Now, what is the discount rate? 10%, which examiner will provide. Now, what is the period? The period is a year, which means I acquire and I'm supposed to pay 22 million then, but I defer to pay it in a year time. Therefore, discounting back 22 million payable 1st of April 2017 back to 1st of April 2016 will give us this, which is this formula we have used. Okay, A, what is A? A is our future value. R is our discount rates. And N is our tenor, which I can, let me try and insert there. Deferred period in years. Oh, yeah. In this case, the deferred period is 1 year. Therefore, I can link it to 1. If the deferred period is 2 years, it will change. If it's 3 years, it will change. Like that. Okay. Now, what has happened? In year 1, which is even the only year, since it's 1 year gap, we have to unwind the discounts. But unfortunately, the whole 1 year interest span across another period. Remember, it's from 1st of April 2016 to 1st of April 2017, whereas our own year runs from January to December. Therefore, I'll have to accrue only 9 months since I'm preparing my account as at 31st December 2016. I have to cut off the 3 months for January 2017, February 2017, March 2017 out of it, which means in this case, I'll adjust for 9 months now is what I'm going to consider and not, and in that case, what has happened? I'll only compute interest for 9 months. And in that case, it will be whatever I have there multiplied by 9 divided by 12, which is 1.5. That 1.5 will be charged to finance cost, which is in good profit, and credited to deferred cash consideration, which is my balance sheet item. If you have questions, you can ask, which then means that the first adjustment I have here is to recognize my finance costs. Individually, they do have finance costs, but the parent has finance costs at the end of the day because of the unwinding of discounts. If you remember our discussion in class, in this case, it's 1.5. Okay. And that's the first adjustment. Let us assume this is the only adjustment we have. If this is the only adjustment we have, will come here and say, okay, to what extent does this 1.5 affect the parent and NCI? Since the finance cost is the cost of the parent, because it's the parent that seems to have obligation to pay the former shareholders. In that case, it has no bearing with the NCI. Therefore, the entire adjustment here goes to the parents. And that's how we take care of it and automatically adjust for itself. Okay, that is the first information. If there's any question, I can answer you. Now, the second one is that if you remember, on 19th of May 2016, Arsenal sold goods to Chelsea for 50 million. Arsenal itself bought it for 40 million, which means Arsenal has made profit of 10 million from Chelsea. But at the end of the year, we were told that Chelsea had in its inventory 40% of the worth of goods purchased by Arsenal, purchased from Arsenal in its store. What it signifies that 40% of those goods were not sold by Chelsea. Invariably, it then means that Chelsea is unable to pass the burden of the profit made from it by Arsenal to its own customer. But there's no problem with that. It can be sold next year. But where the problem lies is that Arsenal and Chelsea have to be consolidated as a single entity. It then means the profit carried by Arsenal will erroneously have been overstated because a portion of it is from itself through its subsidiary. Therefore, we have to eliminate that. Couple the fact that as a group, the group will have been carrying the inventory attributed to part of Chelsea's goods, unsold goods, at above cost because of the profit that has been loaded to it at the point Arsenal sold it to Chelsea, with the hope that Chelsea will have sold all of the goods as at the end of the year. Therefore, what do we do? What we do is to now carry out adjustments for that. Now I've created my template for that adjustment. And is it? Therefore, what do? I'll start that, okay, what is intercompany transaction revenue? Arsenal sold goods to Chelsea at 50 million. Therefore, 50 million or figure in thousands is intercompany transaction. Okay. Now let's go back, which is the same thing here. Now, but how much did it cost the seller? Profit of intercompany sales, let me say, to the seller. In this case, the seller is Arsenal, which is a parent. Remember, it cost Arsenal 40 million. If it costs Arsenal 40 million, it then means that Arsenal made 10 million naira out of Chelsea. No problem. But we are told that of this 10 million naira, we can't consider it all realized because 40% of the goods are unsold. Therefore, we are going to consider 40% of this, which is what we have here. 40% of it is unsold. And it means unrealized profit is 4 million. Now, remember, we needed 3 things to adjust for when it comes to intercompany sales. What are the 3 things? Intercompany revenue is the first adjustment because there's a double count in here. 2, intercompany cost of sales, because there's also a double count in here. The effect that there's a profit that is loaded on this double counter. which you have to eliminate. And that is what will lead to the third, which is having to adjust unrealized profit against this gross profits. But it is easier for us to obtain intercompany sales revenue, which is what was transacted and agreed. And it's also easier based on what we've done to determine unrealized profits, which is 4 million. Now, netting of this 50 million with 4 million will assist us to determine intercompany cost of sales adjustment, which means intercompany cost of sales adjustment, which was the second adjustment, as earlier pointed out, is the difference between intercompany sales revenue and the unrealized profits. And what is the unrealized profit here? 4 million. And therefore, our adjustment for intercompany cost of sales will be 46 million, which means in that case, what entry will you have passed? For adjustment of intercompany sales revenue, it will be debit subsidiary sales revenue, credit parent inventory, as the case may be. Okay, in this case, sorry, it is the who sold to, the parent sold, therefore, parent revenue, and subsidiary has the inventory, subsidiaries inventory. Okay, now that is it. Therefore, we'll pass the entry. The entry borders on intercompany cost of sales. There's revenue. For eliminating intercompany cost of sales, you debit subsidiary inventory and you credit parent cost of sales. And in that case, 46. Net, what happens? See what happens. Revenue will be reduced by intercompany revenue. If you remember this entry, when you debit revenue, what are you doing? You are reducing it. Also, when you credit your cost of sales, you are also reducing it by that 46 million. Okay, but take notes, because of the signs here, you need to take note of this. Okay, that is that. Now, automatically, we've adjusted for the three: intercompany revenue, intercompany cost of sales, and unrealized profits. Those are the adjustments we've made. And there's no adjustment for distribution costs, there's no adjustment for admin costs, and there's no adjustment for tax. And that is how we're able to do this. Now, remember, we've attributed this finance cost adjustment to parents. Who should we attribute unrealized profit adjustment to? It depends on who sold. Who sold in this case is the parent. Therefore, the entire unrealized profit is equally attributed to the parents. In that case, no adjustments against NCL. Therefore, we have our position as this. And this is how we easily determine profit attribution. Now, what do? We just transcribe this or link it, as the case may be, to what we have done earlier. Again, I link MAGMI and distribution. And when I sum that, I deduct it, I have profit for interest and tax, my interest. I link it to the group and my tax. I equally link it. And this is what I present to the examiner. I remember I have to attribute this profit, which I've done the maths. Yeah. I link this. Sorry. And I link this. And that is that. All things being what? Equal. That is my profit or loss. Okay. But again, I was told to do statement of changes in equity. Therefore, I need to bring in some information that is critical to me. Now, what is pre-acquisition retained earnings? Pre-acquisition retained earnings is what the retained earnings is as at the time we acquire. Okay, but we don't need it for balance. We only need it for balance sheet, not for this. But again, why do we need it here in case of next time? Is because in determining our retained earnings brought forward from a consolidation point of view, we need to adjust for it. But let's look at it. All of the retained earnings brought forward as of 1st of January 2016 are all pre-acquisition plus something, are all pre-acquisition. And therefore, how much is that? 65 million. But that's not the only. I'll now put a stake here. Plus fraction of the profit for the year. That is January to March 2016 is what constitutes our pre-acquisition. Remember, profits from January, February, March are not consolidated because it was not associated at that time, which means that that portion of profit plus the beginning of the year balance, 65 million, constitutes what the pre-acquisition profit is. Okay, subsidiaries retained earnings brought forward. In this case, it will be nil for consolidation purposes. Why? Because as at December 2016, Chelsea is not a subsidiary of the parent, which means in that case, we can't consolidate it. Therefore, we'll consider this nil. And that's why I said not a subsidiary as at that date. Therefore, it's not relevant. Parent retained earnings brought forward. We can see it here, which is 120. And off we go in thousands. Now, non-controlling interest as acquisition date. I think they've done the valuation for us. Here, it was stated, let me enlarge. It was stated here that NCI at acquisition date was measured at proportionate share of the identifiable net worth assets. And we are told that it was 20 million, which means we don't need to bother ourselves doing the evaluation. But in class, we've done it before where we have to do it ourselves. Okay, in that case, what is it? 20 million. That is that. Now I'm doing this because I might be needing those information. Now let's go back here. Now, these two color pages are critical for us if you remember our discussion, but we'll come back to those, but let us insert what is clear. The share capital of Arsenal is 200 million. And the profit for the year is already attributed from what we have here. The parent, 59,500. NCI is 3,750. We have no comprehensive income, therefore it's nil. Now we have transaction with owners of equity because there's no opening balance for NCI. Before now, we'll have done opening balance for NCI with this equation or narrative. But remember, as at the beginning of our year, 1st of January 2016, there was nothing like subsidiary until April. It then means that there's no opening balance for NCI. Let me put a review note. In the year of acquisition, of a subsidiary, there is no opening balance for NCI. Rather, there is an added on acquisition value to recognizing the amount of NCI at acquisition date. That is how you bring the subsidiary into the books for the first time. Okay. Okay, so I can see that every point in time. Now, that is which means rather we'll bring in added on acquisition, which is the amount of NCI as at the date of acquisition, which is what we have here, which already has been measured as proportionate share. Of NCI's stake in the net assets of the subsidiary. And that's the issue you have there. Take note. Okay, that is that. Now, what means this is a zero? The only one we are waiting for is the retained earnings. We'll come down here to do that. Retained earnings of the parents brought forward is 120, which is what I put in, 120, as you can link it there. Now, remember, NCI, the same thing we have here, NCI will not have any value as of that date, as of 1st of April or 1st of January 2016. Chelsea was not a subsidiary of Arsenal. Hence, there is no opening balance consideration. Therefore, that's why this will be nil. That's why it's nil. It then means it's only the parent that is there. All the adjustment will always do by first of all trying to remove the pre-acquisition and later take the share of the parent, and NCI will not apply. The same thing here. That's it. Therefore, I'll only link this to this. And that is it. At the end of the day, we are able to produce our consolidated statements of changes in equity. Any question? Somebody said, I didn't understand the number two additional information. What is number two additional information? Can you read it aloud? Let me give you access. Okay. I can't see the person again. The person was using iPhone. I can't see the person again. But what is here is simply adjusting for intercompany transaction relating to sale of goods, which affect intercompany revenue, intercompany cost of sales, and adjustment for unrealized profits on inventory. Okay, that is that. Yeah, that is a solution for what has been given to you guys. If there's any other question, kindly show by raising up your hand, or I can also share similar question. Let me share similar question from any other question. I'm trying to call up my Kindle so that I can show you one or two things here. Remember all of the steps we took? Take note of them. Okay. It should be ready now. Okay. 10% to go. Okay, it's ready. Okay. Okay. Now this is the other one. You can see from the text. Can somebody read this? And let me enlarge it. Okay, can somebody read this? Who will volunteer? Who is Kasarachi? Okay, over to you. Okay, in case you are not there, who is MC Square? Can you unmute?
Arsenal acquired 80% interest in the equity of Chelsea as January 1st, 2015, when the retained earnings stood at 20 million naira. The board of Arsenal strictly wants to comply.
Okay, Ifeanyi Chukwu, over to you. Ifeanyi Chukwu.
Hello, sir.
Okay, can you read?
Okay. Question 3. Sir, shall I continue question 3?
Yes.
Arsenal acquired 80% interest in equity of Chelsea at January 1st, 2015, when the retained earnings stood at 20 million. The board of Arsenal strictly wanted to comply with the requirement of IFRS regarding consolidation of the financial statement of the subsidiary with that of the parent as at December 31st, 2016. Income statement for the year ended December 31st, 2016. Arsenal and Chelsea. Should I read the figures? Should I just
read the figures?
Okay, revenue, Arsenal, 600 million. Chelsea, 390 million. Cost of sales, Arsenal, 345 million. Chelsea, 201 million. Gross profit, Arsenal, 255 million. Chelsea, 189 million. Distribution costs, Arsenal, 75 million. Chelsea, 45 million. Administrative expenses, Arsenal, 105 million. Chelsea, 90 million. Profit on Arsenal, 25 million. Chelsea, 29 million. Profit for the year, Arsenal, 50 million. Chelsea, 25 million. Movement in reserve. Retained profit brought forward for Chelsea, for Arsenal, 120 million. For Chelsea, 65 million. Profit for the year, Arsenal, 50 million. Retained profit carried forward, Arsenal, 170 million. Chelsea, 90 million. Additional information. As an acquisition, the parent, in addition to the share consolidation, share exchange, offer to former shareholders of the subsidiary a cash payment of 28.8 million is due to pay on 31st December 2016 to the shareholders who sold their stake to the parent. The hurdle rate in bracket or cost of capital of Asna is 20%. 2B, Chelsea sold goods to Asna for 50 million when it actually cost the parent company 40 million. At the year end, included in the inventory of Asna PLC is 40% of the inventory sold by Chelsea PLC. C, as at the reporting date, 31st December 2016, the goodwill has been impaired to the tune of 12 million, and of which only 5 million represent the impairment loss attributed to 2016 financial year. So please scroll up. Required, prepare consolidated of profit or loss and the consolidated statement of change in equity, given that the share capital of Asna stood at 200 million and the Chelsea amounted to 100 million, and the amount of non-controlled interest at acquisition as measured at fair value stood at 24 million. Thank you, sir.
Thank you very much. Thank you very much for that. That is what I've more or less given you guys as assignments, as the case may be, or homework, as the case may be, for you to also demonstrate your understanding of that. Okay, we are going to have the final leg discussion on diluted EPS, but I've said it earlier, understanding of basic EPS account for 60 to 70% of what we'll do tomorrow, which means it's just a building block. We'll be adding to the body of knowledge to determine our diluted EPS. Any other question? Any other question? Okay, if there's no question, I think we'll call it a day as you await your second lecture by 4 p.m., which is you have 1 hour 30 minutes for break, or I think it's serving you 4 p.m. Yeah. Take care. Thank you, and God bless you. Bye.